prices have been very volatile lately, which makes it harder to keep inflation expectations steady. Since the start of this month, oil prices have jumped by over 3% in a single day on 6 different occasions. Right now, the prices are back to where they were in mid-September. This recent movement is closely tied to the situation in the Middle East. Whenever there's news suggesting the conflict is easing or not getting worse, oil prices tend to settle down. That's because the current oil supply is enough, and the demand isn't very strong. Whether oil prices settle at 75 or 80 per barrel next year won't make a huge difference for inflation in Europe. It might impact the overall Eurozone inflation by less than 0.15% and core inflation by about 0.2% in 2025. However, because both the Eurozone and US economy are just coming out of high inflation period, any signs of the new supply crisis could easily stir up the inflation fears, even if they aren't fully justified. Looking ahead, it's hard to predict whether the oil prices will go. The Iran-Israel conflict could escalate, pushing the prices higher, or things might calm down for a while. For now, we believe that the oil supply is strong enough and demand remains weak. And then for the USD, as the inflation fall back to target levels, concerns about the inflation risk have lessened, which makes sense. However, with more central banks easing their policies, investors should remain cautious, especially with the geopolitical risk potentially driving up the commodity prices. Over the past 6 weeks, inflation risk has increased for several reasons. Central banks have eased more than expected. Commodity prices have surged due to the Middle East conflicts and Asian stimulus measures. The US economy may avoid a severe recession, suggesting a stronger demand and inflation. The US inflation data for September was higher than expected, raising concerns that inflation may stick around longer. Money supply growth is accelerating, a signal that inflation could rise again. If inflation rebounds, the market could see another sell-off in bonds and stocks, and central banks may need to keep tighter policies for longer. So, despite recent declines, inflation risks are still worth watching closely. For gold, the key factor supporting the rebound is that the demand for gold remains high. Among central banks, while China has clearly slowed down its accumulation in the second quarter of 2024, India has also clearly accelerated its accumulation. In the second quarter of 2024, India's gold reserves increased by 18.7 tons, only slightly less than Poland. In the first quarter of 2024, India's purchases only slightly decreased. As a result, the Indian bank have increased their gold reserves by 4.6% in just half a year. The central bank's gold reserve also reflect the economic importance of a country. In time of severe crisis, that is the most critical time, gold is even more reliable than the main fiat currencies, US dollar and euro. Another key driver that continues to support gold is the decline in interest rates, which helps boost gold prices. This have been true for each of the 3 phases of rate cuts since the turn of millennium. And that is all for today. Thank you for watching.